In this Chapter 4 tutorial, we're going to go through completing the accounting cycle. So in the first 3 chapters, we basically went through these first 6 steps here. We basically identified and analyzed transactions, we recorded journal entries, we posted the journal entries to the ledger, which we used T accounts, and then we prepared an unadjusted trial balance. And then in the last chapter, we talked about recording and posting adjusting journal entries. What we're going to do today is go through a review of the first 6 steps, but also complete the accounting cycle to the very last step, number 9. So before we get started on the new material, I want to just review accrual-based accounting. Accrual-based accounting says we have to provide and record the transactions as they occur. It does not matter when the cash is exchanged. Whenever there is an impact on the accounting equation, we have to record those transactions. And we said that at the end of each accounting period, before we prepare the financial statements, we have to do what's called adjusting journal entries. Now, there's 4 things to keep in mind with respect to adjusting journal entries. They're done to ensure that the revenues that are earned are recorded, the expenses that have been incurred are also recorded, and those which show up on our income statement. And it also wants to make sure that our assets and liabilities are updated as well, so that the proper amounts show up on our balance sheet. And so just to sort of summarize, every adjusting journal entry affects at least a revenue or expense account, and the other account would be an asset or liability. So if you're doing adjusting journal entries, and let's say you know that you're trying to record revenue you always record with a credit, so then all you're trying to figure out is what is the account that is being debited. If you're trying to record an expense, expenses are always recorded with a debit, and so the other account that you're trying to figure out would be the credit amount in the adjusting journal entry. And remember, adjusting journal entries never involve cash. Now, what we're going to do as a bit of review is we're going to go through these 3 problems in this video tutorial. Exercise 4-2, 4-4, and 4-5. So take a minute and read through those exercises. They all relate to skydive tours. So it's basically one company spread out over 3 problems. Now, we're going to tackle the problems a little bit differently, but for now, just review the problem. And then once you review the problem, then resume the video. The first thing that I want to do is set up a T account for each of the accounts that are listed on exercise 4-2. So when you look at exercise 4-2 on page 213, you'll see it starts with cash, accounts receivable, so on. So what I want you to do first is set up each account using a T account and put in the unadjusted balance. So you see that in exercise 4-2, we're given the unadjusted trial balance. If you think about where we are at now in the accounting cycle, this is where we're at. So this is the starting point for exercise 4-2. The company has recorded all the journal entries, they posted those to the ledger accounts, and now they have the unadjusted trial balance. So that's sort of where we're at. So set up T accounts for each of those accounts, and I've done that already, so this is basically what it should look like. This is what your T account should look like. You should have a T account for every account, starting with cash, then accounts receivable, then your liabilities, and then all your equity accounts. So set that up on your own. Once you have that set up, then we're going to record the adjusting journal entries. Now, the adjusting journal entries, they're listed in exercise 4-2, A, B, C, D, and E. And once you have recorded the adjusting journal entries, then post those amounts to the T accounts and then update the adjusted balance on the T account. So once you have the T account set up, record the adjusting journal entries. Once you recorded the adjusting journal entries, post those to the T accounts and then come up with an updated balance on each of the T accounts. So pause the video now to complete those steps, and then once you're done, then resume the video. Okay, let's take a look at our T accounts first. So what I have here are all the T accounts that we started with. So I've listed all the assets in the first column, and then in the middle column, I started with the liabilities, and then we have the capital and withdrawals, and then the revenue and expenses in the final column. So these are the starting numbers from our unadjusted trial balance. And I'll just scroll down to show you the rest of the T accounts. So these are the rest of the T accounts with their unadjusted balance. And so we said that this is where the company is currently at. This is things that have happened throughout in this case, the month of September. And now we're going to record the adjusting journal entries. So then the adjusting journal entries are all over here. And remember, adjusting journal entries, we're trying to make sure that we capture all the revenue and all the expenses for this period. So if you look at each adjusting journal entry, it's either trying to record revenue or an expense. The first one, we're trying to record the additional revenue that we've earned, but we haven't yet collected this amount. Once again, this is called an accrual, so the cash is going to come later. We earn the revenue now, so we have to record it in September, but the cash is going to come later. And then if we look at the remaining B, C, D, and E, these are all trying to record expenses for the month of September. And so all these expenses happen now, even though the cash was exchanged at a different point in time. So just take a look at all these adjusting journal entries and make sure you have those correct before you update these amounts to your T account. So pause the video here, and then once you have ensured this is correct, then we'll review the updated balances in the T accounts. Okay, let's go look at our T accounts now that we've added the adjusting journal entries. Now I put the adjusting journal entries and the final balances in a different color just so it's a little bit easier to see. So just take a minute. I'm just going to leave this here for about 10 seconds. So just double check to make sure you have the same amounts and from the adjusting journal entries and the same closing balance that I have on these accounts. And then I'm just going to scroll down. If you need to pause this now. I'm going to scroll down and then just show you the remaining T accounts here. So now we have all the adjusting journal entries done, and we posted them to the ledger or the T accounts. So then let's go back to our accounting cycle and see where are we at here. So we've done the adjusting journal entries. Now we have posted them to the T accounts. Now we have to do step number 6, prepare the adjusted trial balance. Now the adjusted trial balance, all we're going to do is take the ending balances from our T accounts, list them in order of our assets, liabilities, and then owner's equity, list the corresponding debit and credit balance, and all we want to make sure with the adjusted trial balance is to make sure the debits equal the credits. Now, there is an example on page 181 of your textbook, so if you forgot how to do adjusted trial balance, look at that example, prepare the adjusted trial balance for Skydive Tours at September 30th, 2020. And then once you've done that and you ensure that the debits equal the credits, then resume the video to compare your answer to the solution. So pause the video now. Okay, let's take a look at our adjusted trial balance. So all we're going to do then is list all the accounts individually with their respective debit and credit balance, starting with the assets, then the liabilities, and then the owner's equity account. So if you look on the screen here, we have our adjusted trial balance, and all it is just making sure that the debits equal the credits and making sure we have that equilibrium, which we do. So check to make sure that this is what you have on your adjusted trial balance. So you could pause the video here, and then once you've confirmed all these amounts, now these amounts are just taken from the T accounts above, then we can move on to the next step. So this is all good. Now let's go on to our next step. Now, if you think about our next step, we have now done the adjusted trial balance. And if you look at our accounting cycle, step number 7 then is to prepare our financial statements. So what I want to do next then is continue on using this same question. We are now going to the bottom of page 1 on our handout. We're going to prepare the 3 financial statements for Skydive Tours. Now, just before we do that, there is this optional step that the textbook talks about, creating an accounting worksheet. That's just to sort of summarize everything on one Excel document to make it a little bit easier, you can just sort of review that on your own, pages 175 to 176. Now, some of the questions in your textbook talk about an accounting worksheet. Once again, this is an optional step, is not required. What we can do is actually just take our adjusted trial balance, what we just prepared, and now we can prepare the three financial statements. Now remember, they have to be prepared in order: the income statement, followed by the statement of owner's equity, and then the classified balance sheet. So we talked about the classified balance sheet in the earlier chapters. That's where we separate the assets and liabilities between current and long term. Now, this is the chapter where they talk about that, but because we already learned how to do a classified balance sheet, we can just jump right into it for this question. So using your adjusted trial balance, prepare the three financial statements. Once you have those prepared, then resume the video. So pause the video now to prepare the three financial statements. Okay, let's have a look at our financial statements. So remember, whenever we're preparing financial statements, we've always got to prepare them in order. So the first financial statement, as we see here, is the income statement. And all the income statement does is it lists our revenue minus our expenses, and we calculate our net income or net loss. Now, if you look at the expenses, they're always listed in order of largest to smallest. And once again, that's going to help a financial statement user identify which is the largest expense for this company. And so this company has net income for the month of September of $12,520. Now remember, if you read the question carefully in E4-2, it says, ask you to calculate the net income for the month ended. So companies could prepare monthly financial statements. It could prepare them annually, quarterly. This is for the month of September. And then after we have the income statement prepared, we then prepare the statement of owner's equity. Remember, the ordering is important because this net income number is going to flow to our statement of owner's equity. And so once again, name of the company, Skydive Tours, financial statement name, and then the period of time. We start off with the capital account at the beginning of the month. We add our net income, and then we subtract our withdrawals. The withdrawals is the amount of money that the owner took out from the company. And this ending balance for our capital account, that will flow into our balance sheet. And so let's look at that next. And once again, pause the video at any time if you want to make sure that you have the same answer that I have on the screen here. Now with the balance sheet, we're doing what we call the classified balance sheet. Now we don't have to put classified in the actual heading of the financial statement. We just have to, this is the requirement that we have to do in Canada. So here in Canada, whenever you're preparing a balance sheet, it has to be classified. So at the top of the screen, we have the name of the company, the name of the financial statement, and the balance sheet is always at a point in time. So it's just on that very last day that we're preparing the financial statement. So that's September 30th, 2020. We separate our assets from current to long term. And remember, current assets are always listed in order of liquidity, how easily or quickly they can be converted into cash. So cash is always going to be the most liquid current asset. We do a subtotal for our current assets, and then we put our long-term assets, and then we do our total. On the other side, we have our liabilities. And in this example, we only have current liabilities. We still have to put the heading current up here at the top. But because we don't have any long-term liabilities, we can just go directly to our total liabilities after we list the current. But because we have this heading that says current, we will know that all these liabilities that we have are all current in nature, meaning that we're going to pay off all these liabilities within 1 year from the date of the balance sheet. And then we have our owner's equity. Remember, this number from our owner's equity flows from our statement of owner's equity. And the balance sheet just tells us that we have this equilibrium, that our total assets of $91,000 equals our total liabilities plus owner's equity, also $91,000. And remember, we said that we can do a little bit of analysis. We can say that this company has total assets worth $91,000. Of that $91,000, $12,420 are owed to third-party creditors. The remaining $78,580 has ownership by the owner of the company. Now, once we have the financial statements prepared, let's go back to our handout and have a look at what is happening next. So we prepared our financial statements. Now let's go to page 2 of our handout. Now we're going to do some additional financial statement analysis. This is where we look at ratios. And in this chapter 4, we're going to look at what we call the current ratio and also the debt ratio. Now when we calculate the current ratio, all we do is take our current assets divided by our current liabilities. Now, generally, a higher ratio is better. The current ratio assesses the company's ability to pay their current liabilities as they come due. So we have current assets in our numerator. Current assets are good. We have current liabilities in our denominator. We don't like liabilities, so think about current liabilities as things we don't want. So a higher current ratio is better. Now, the textbook says that a current ratio of around 2.0 is a strong current ratio. That means we have double the amount of current assets as we do current liabilities. And then we also have what's called the debt ratio. The debt ratio just measures what's our ability to pay all of our liabilities. And when it comes to the debt ratio, we take our total liabilities over our total assets. Now, total liabilities, we don't like liabilities, so we want less of those. Total assets are good, we want more of those, so generally a lower debt ratio is preferable. Now the textbook says, as a general rule, a debt ratio of below 0.60 is considered safe. Now all these numbers come from our balance sheet, so what I want to do next then is go back to the balance sheet for our company here, Skydive Tours, and now I want to calculate the current ratio and also our debt ratio. So let's do this together. We now have our balance sheet. So let's calculate what is our current ratio. Now we know our current ratio is our current assets divided by our current liabilities. So we just have to grab those numbers from our balance sheet. Our current assets, $31,740. And our current liabilities, $12,420. Now remember, we don't have any long-term liabilities in this example, so we just take our total liabilities, which is also our total current liabilities. And if we round this to 2 decimal places, we get 2.56. And so once again, generally speaking, current ratio in the range of 2.00 is generally considered good. So this is actually a pretty strong current ratio. Now, another way you could interpret this is that what you could say is that for every $1 of current liabilities, the company has $2.56 of current assets. So for every $1 of current liabilities, for every $1 of our denominator, the company has $2.56 of our numerator current assets. So once again, that's really good. We want more current assets for every dollar of current liabilities. And then we can look at our debt ratio. So let's look at our debt ratio as well. Now the debt ratio looks at our total liabilities over our total assets. And so our total liabilities, $12,420. This would include both current and long-term, but because we don't have any long-term, it's the same number as our total current. And then our total assets is $91,000. And so we round this to 2 decimal places, we get 0.14. Now remember, the textbook says that anything below 0.6 is usually good. So this would be a strong debt ratio. And once again, another way of interpreting this is that we could say for every $1 of assets, remember that's our denominator, the company has 14 cents of liabilities. And that's actually good. So for every dollar of assets, our denominator, we have 14 cents of liabilities. So that's actually a really strong debt ratio. So that's some financial statement analysis that we can do with respect to our financial statements. So then let's go back to our handout. And let's look at the next step. So now that we have done the financial statements, we are now going to go to what we call the closing process. The closing process is done at the end of the fiscal year or the fiscal period. And this is after the financial statements have been prepared. The closing process is just done to get everything ready for the new accounting year. And the purpose of this closing process is to basically bring our temporary accounts to zero. Now, when we talk about temporary accounts, those are the revenue, expenses, and the withdrawals account. So if we think about this, our revenue and expenses are just for that year. When we start the new year, we want to be calculating the revenue and expenses starting at zero. So what we earn this year is going to stay in this year. Once we start the new year, we want our revenue, expense, and withdrawals account to be zero. Now, if we actually think about this, let's go back to our financial statements. If we think about all of our temporary accounts, that is all of our income statement accounts, right? Our revenue and our expenses, those are just for this period. When we start the new period, we want those to be at zero. We also want our withdrawals to be at zero as well, starting in the new period. And if we think about this, all these amounts, the revenue, the expenses, the withdrawals, they all get closed to our capital account. So that's all we're going to do. And once again, let's go back to our handout and look at the steps with respect to the closing process. Now, when we do the closing process, we are actually preparing journal entries. We're actually going to prepare journal entries to do these, what we call closing entries. And the journal entries that we have to do is we have to close the revenue accounts to this new account called income summary. We're going to close all of our expense accounts to this new account called income summary. And then we're going to transfer the income summary to our capital account. And then the last step is to close our withdrawals account to the capital account. So take a minute, read through these 4 steps, and then once you have an understanding of what we're going to be doing, then we'll actually work through the closing process together. So just sort of pause the video here, read through this closing process, and then once you have an understanding of what we're doing, then resume the video. So let's look at the closing process together. What I have here is all of our temporary accounts. So remember we said the temporary accounts are our revenue, expenses, and the withdrawals account. And we're also going to set up this new temporary account called income summary. Now, the purpose of the closing process is to reset the revenue, expense, and withdrawals account all to zero to start off the new year. So we're going to do sort of what we call closing entries. Now, closing entries are, once again, they go into our general journal. So it's just, they look exactly like journal entries, but closing entries are done at the end of the accounting period, end of the fiscal year, and they're just to get the accounts ready for the new accounting period. Now, the first one we want to do is close off this revenue account. So let's go to the revenue T account. It currently has a balance of $24,440. Now, we basically want to get that to zero. So our first closing entry, in order to get the revenue to zero, we're going to have to debit our revenue by $24,440. That's going to bring this account to zero. And then we want to transfer that to this new account called income summary. So now we're just going to put this, I'm just going to use abbreviation. We're going to transfer that revenue to income summary. And so now it's going to be sitting in this T account here, $24,440. The second closing entry is we want to get all of our expense accounts to zero. So let's look at amortization expense. How will we get amortization expense to zero? Well, we're going to have to credit our amortization expense for $260. We're going to actually have to credit all of our expenses, and that's going to get them to zero. So let's just set that up then. So let's go down to our second closing entry. We're going to close off our amortization expense, our salaries expense, our rent expense, utilities, and supplies expense. So all we're doing is just closing all these temporary accounts to zero. Our amortization expense, credit of $260, salaries, $5,700, rent, utilities, and also our supplies. Now, that is all going to go, again, to our income summary account. So now we're going to have a debit to our income summary of $11,920. So once again, the first closing entry, we're going to bring our revenue to zero, move that revenue amount to income summary. Then we're going to close off all of our expenses to zero and move that total of all of our expenses to income summary. So let's look at our income summary T account then. We have our revenue amount, then we have our expenses. Let's just do a quick subtotal. Currently in our income summary, we have a balance of $12,520. Now, if you think about that number here, that's our net income, right? If we look at our income statement, that's our net income. All we've done is moved our net income to the income summary. Now, once again, where does that net income go to? If we think about our financial statements, that net income now gets added to our capital account. So once we have our net income sitting in income summary, our third closing entry is just to move that net income, that income summary amount, to our capital account. So then how will we get our income summary to zero? We're going to have to debit our income summary of $12,520, and now we're going to move that into our capital account. Sorry, 12,520, 12,000. That's our third closing entry. So now our capital account is going to be increased by the net income of 12,520. And let's just do a quick subtotal now. So let's do a quick subtotal in our capital account. Our subtotal is now 84,580. That is the same amount that we have here in our statement of owner's equity. So all we're doing with the closing process is just basically closing our net income to our capital account. Now this subtotal equals what we have in our statement of owner's equity, but this is what we want to end up with at the end of the period. So the last thing we have to do is our fourth closing entry is to get our withdrawals account down to zero. So to get our withdrawals account down to zero, we have to credit our withdrawals, and the debit is going to go to our capital account. So the fourth closing entry, we're going to debit our capital account for $6,000 and credit our withdrawals account to get that to zero. So once again, debiting the capital account, crediting withdrawals, the withdrawals will go to zero. And then our final total for our capital account is $78,580. And once again, that agrees with what we have on the statement of owner's equity. So that's all we're doing, getting everything ready now for the next fiscal year. Now, if we go back to our T accounts, we know that after the closing process, all of our temporary accounts, our revenue, our expenses, and our withdrawals will now all have a zero balance. So going into the new year, they're all going to have a zero balance. We can now start calculating our revenue and expenses and our withdrawals for the new zero beginning at zero. And our capital account is going to have the right balance starting in the new year as well. So that's the closing process. Now, there is still one final step. So we go look at our accounting cycle. We have now done the closing entries, and now we're going to prepare what we call the post-closing trial balance. So let's scroll back to page 2 of our handout. Now, the post-closing trial balance, there's an example on page 186. Now, if you look at page 186 in your textbook, what you'll see with the post-closing trial balance, it just looks like a regular trial balance. All we want to do is make sure that after we've done our closing entries, that our debits equal our credits. Now, the thing to notice about the post-closing trial balance is that all the temporary accounts are gone. They have a zero balance. And so all we see is our balance sheet accounts, our assets, liabilities, and our capital account. So for the very, very last step, I want you to prepare a post-closing trial balance for this company. And then once you've done that, then compare your post-closing trial balance with the solution. So pause the video now. Okay, let's look at our post-closing trial balance. So this is our post-closing trial balance. Once again, this is the final step in the accounting cycle. All we want to make sure is that after we've done the closing entries, that our debits equal the credits. And you can see that all we have on the post-closing trial balance is our assets, our liabilities, and our capital account. Because all of our temporary accounts, the revenue, expenses, and withdrawals, all have a zero balance now. And once we have this equilibrium, debits equal credits, then we're done with the accounting cycle for this year, and then we can start the new year all fresh. And only these permanent accounts, these are known as permanent accounts, will have a balance. All the temporary accounts will have a zero balance going into the start of the next year. So let's go back to our handout. Let's just sort of wrap up for chapter 4. Now, in chapter 4, there's also an appendix for what we call reversing entries that will not be examinable. What I suggest you do for extra practice is there's a really good summary problem on page 195 to 200 in your textbook. The summary problem gives you the question, then it goes through a detailed step-by-step solution. And also do exercise 4-21. Now 4-21 is a continuation from the exercise that I asked you to do for chapters 2 and 3. And so once you've done a summary problem, then work through exercise 4-21. So this brings us to the end of the tutorial for chapter 4, completing the accounting cycle. Good luck with your studies, and we'll see you in the next video tutorial.